A company will have different types of expenditure. How will revenue expenditure be treated in the accounts? I'm Thomas Harwood and welcome to the Accounting Student, where we create free and short videos so that you can learn about accounting. Today's video is looking at what is revenue expenditure. Usually, a business will have cash coming in, which can be known as income, and cash going out, which can be referred to as expenditure. Expenditure can be defined as a payment or agreement to make a payment, which in return a benefit, asset or service will be received. Business expenditure can range from anything from the purchase of office furniture to paying the petrol bill to refill a van. As there is such a mixture of expenditure, it may be beneficial for a business to categorize them into particular groups, as these will possibly be treated differently in the accounts. In the accounting world, there is the idea which is adopted in practice of categorizing expenditure into two main categories, and they are known as capital expenditure and revenue expenditure. In this video, we will look at revenue expenditure. Revenue expenditure is recognizable when the expense is incurred in running a business on a day-to-day basis. Unlike capital expenditure, revenue expenditure is not recognizable when a business spends money on enhancing the worth or value of fixed assets. The main difference between revenue expenditure and capital expenditure can be demonstrated with the total cost of operating a motor vehicle. Initially acquiring the motor vehicle for the business is an example of capital expenditure. This is because the vehicle will be in the business for use for at least a few years and therefore is a fixed asset. On the other hand, paying for petrol to use in the motor vehicle will be a revenue expenditure. This is mainly because the petrol or expenditure will be used up in a short time and does not add long-term value to the fixed asset. Additionally, it is fundamental that there is a correct distinction between capital and revenue expenditure, as this is essential to determine a correct value for the profit and assets of a business. Let's have a look at an example to demonstrate how we identify revenue expenditure. Davina has her own advertising and media company. Davina has a specialised printer that contributes heavily to the advert service the company provides. She recently bought a bundle of ink toners to cope with demand. Davina is confident that the printer is capital expenditure because it is a fixed asset. However, she is unsure whether the ink toners for the printer can be recognised as capital or revenue expenditure. So there are two main questions we need to ask. The first one is the expenditure directly incurred in bringing a fixed asset into use for the first time? In this example, the ink toners are not directly incurred in bringing the fixed asset or printer into use for the first time because it was already in the business and in use. This indicates that the ink toners may be revenue expenditure. The second question is, did the expenditure improve a fixed asset beyond its capability when first owned? The ink toners were bought to assist the printer to do its main job of printing or copying the adverts of work required. This is not improving the printer's ability. It is just helping print and copy work at the same standard. To conclude, the answers from the two questions suggest that the expenditure will be classed as revenue expenditure because the expense is incurred in running the business on a day-to-day basis and not in enhancing the worth or value of fixed assets. So that was the explanation of what is revenue expenditure. If you enjoyed it, press the like button. If you have a question you want answered, leave it in the comments below and we'll try our best to answer it. And if you're not already subscribed, make sure you click the red subscribe button to keep updated with the Accounting Student. Thanks for watching. We'll see you next time.